Oh my gosh! Speaking of a guy who never has been in a Walmart, here's David D'Arcangelo. What's up, David?
Good segue, Bob. How are you?
Hi guys, how we doing?
Have you ever been to a Walmart?
I've definitely been to a Walmart.
Yeah.
I go to Walmart, Target, and Walmart. They're fun.
I've been in there.
If you got teenage kids, that's a good place to go.
We have a 10-year-old. We're
I
regulars.
see. That's See, when you got kids,
Oh, yeah.
it's a place to go.
You just let them go.
You just let them go.
McDonald's is there, and they got the toys over there.
Oh, yeah.
Food, yeah.
And they're breeding other Walmart shoppers as they go. You know, they're getting them fatter, and you can pass your paychecks there. So.
Have your cameras ready, too, because a lot of times you'll see fashion risks taken there.
Isn't there a website that has people of Walmart?
We'll bring it up sometime in our life.
We have to look at it first because I don't know if we can
just
put it
have
on national
lunch,
television.
please.
David D'Arcangelo is the author of The Secret Asset, Making Millions with Investment-Grade Life Insurance. Of course, his website, thesecretasset.com. And Russ, he's captured Russ's imagination. We've been in the show for 16 years. Not many people would get to come back. Well, they don't, because it's just, let's face it, it's not that compelling. This is one of the most compelling subjects we've ever talked about. And it's life insurance, believe it or not. Very simply stated, life insurance isn't death insurance. It's about investment these days, isn't it?
Yeah, if you go back, the biggest thing they have is the IRS gave them what's called IR code 7702, which basically says if you overfund a life insurance policy by the minimum death benefit, not the maximum,
okay,
overfund the premiums. After the fees come out each month and each year, the excess money grows tax deferred.
Yeah, so if you were to take a pie chart of this, is the best way I've been able to see it happen.
I love pie charts.
Yeah, if you take a pie chart and you say this is your whole insurance premium here, okay?
Right.
A little sliver of that pie chart goes to the cost of that insurance. In other words, another little piece goes to the administrative thing, okay? The rest of it is surplus, right?
Correct.
Now that surplus doesn't just sit there; it grows.
It sits
It
there.
should grow, right?
So I call it the eighth wonder of the world.
Oh, good.
So it sits there and it grows tax deferred. Well, in any other thing, retirement plans, IRAs, they grow tax deferred. Annuities grow tax deferred, but there's always a day of reckoning at the end.
When you take it out, you pay your...
So if you put $100,000 into something and it goes to $1 million, you pay no taxes. When you take it out, if you're in the 40% tax bracket, that's $400,000. In this vehicle, you grow a tax deferred.
Okay.
And you can take out your basis, just like a house, tax-free. And then
but hold on. Let's explain basis for our listeners. Cost basis is what you paid for it.
What you paid.
Okay, so if you paid $100, okay, and now it's worth $200, you pull your basis out, you pull the $100 out. Right. Okay, tax deferred.
Yeah. And now the big pile of money that your $100,000 that grew, you put in 5,000, 10,000, whatever it is, it grew to $1 million.
Yeah.
So after you get your basis out, then the rest of it, you take it out in what we call withdraw it via a loan. It's your money. It's like a bank.
Yeah.
Right. Now, isn't there an interest rate that you have to pay it back on?
Yeah, most of the policies, what they've done now, a few different companies they call it a net zero cost loan. They debit you 2 or 2.5% or 3%,
right?
And they credit you 2 or 2.5 or 3%. So it's a net zero cost. So in other words, you grew this money, it's your cash, you withdraw it.
Yeah.
You just have to leave a little bit of cash in at the end to take care of the death benefit until you die. But that's okay because you keep reducing the death benefit down while you're taking your cash out so that your costs are always at the minimum.
Right.
So you follow me? So it's just mathematics.
Wow. And what you're basically doing is you're overfunding your insurance. In other words, so let me put this in terms of
I'm going hazy. Hold on. Slow down, boys.
Well, that's good because and this is a reason Russ is on the air because there's those people driving. There's just people that are swerving on the road right now that are trying to think. I'll tell you what we're going to do. When I come back from the break, I'm going to explain that to you in plain English. But think of it this way: you've got your auto insurance every month. It costs you $100.
Yeah.
Okay. Imagine if they let you pay $200, and that extra money that you paid went to work for you. Okay.
Yeah.
Now, how would you handle the taxes on the money? How it grows? That's how he's telling you. Okay.
Right.
So just think about that when we come back from the break.
I'm going to need about 3 minutes here.
Well, you're going to have about 3 minutes, exactly. And David D'Arcangelo is going to come back. He's going to tell you how to break it down again.
It's a love-hate thing with you.
Well, but the thing is, though, it's a fantastic idea. And I don't know what. The one thing I want to ask you when we get back from the break. What happens if you're 50 years old out there listening to us? Is it too late? We'll answer that question when we come back. Russ and Sellers.
Yeah.
Stand by.